Hi, and welcome back to Mike on Money. My name is Michael LeBlanc, Senior Portfolio Manager with LLC Private Wealth at CG Wealth Management. And thanks for joining us for our new monthly feature called Monthly Market Mistakes, where we're going to talk about the things we try to avoid in portfolios. We do have our tactical updates every month where we talk about the areas of the market that we like, where we're seeing the portfolios go, where we're seeing the opportunities. But during that process, we come across a lot of things that we think people should avoid and what we definitely try to avoid in our portfolios. So today we're going to be talking about private debt. Now, I know I've talked about private debt before. It's been kind of an issue that I've been trying to raise the flag on for quite some time. A lot of investors are in these or exposed to these without really understanding the risk. And I actually will say, I think a lot of advisors have their clients in these without fully understanding the risk around private debt funds, or they sometimes get classified as alt funds. Several years ago, I think it was back in 2019, the regulators changed some rules around mutual funds, or what we used to call OM funds, or offer memorandum funds. And these were fairly illiquid. They had a barrier of entry. You had to be what was called accredited investor, so a larger investor to get access to them. And the reason was they carried unique risk, and they also carried a lot of liquidity issues. But one of the big changes came in was private debt. So private debt funds, but again, were traditionally for those institutional or more sophisticated investors. And when I say that, I mean people who have means to take some risk and have very, very long time horizons. It brought that class of fund to anybody, basically anyone who wanted to get into it, and it offered some better liquidity, or at least it gave the opportunity for a little bit better liquidity, but it doesn't guarantee liquidity, and that's one of the big problems in these private debt funds. The second is it allowed a lot of companies to start advertising to the average investor, to everybody out there. And you've seen these. I know you've seen these. If you're an investor, you've seen these ads. I see them all the time, but I see people put in their whole portfolios. I've seen a whole portfolio being in these things before. Even if you've got multiple different ones, you're still exposed to the similar risk across the different funds. Just means that one fund might not have the same problems at the same time as the other ones, but you shouldn't be in all in one asset class. So and then other ones, what they ended up doing is hiring sub-advisors. So they take in the money, and then they send that money out to sub-advisors. Sometimes it's one, sometimes it's multiple sub-advisors. And the big problem, if you have a debt fund that uses a sub-advisor structure, is that's a black box. You don't know what those loans are, or you probably can't even get any big details on it, and your advisor can't, and the fund company generally doesn't have any real in-depth details on that, other than here's the yield. And so that's number one. A lot of people do not know where they're lending or where the money's being lent out. And so first of all, make sure you know where the money's going and who's managing it. And, sub-advisors, that's a big, huge red flag in my book when it comes to private debt funds. So that's first thing to keep in mind. Second to keep in mind is when they talk about liquidity, and if they don't have any liquidity, they can stop sending any money out whatsoever. They can just close down redemptions, and you can't get your money out. So that's another big risk around these things that a lot of people don't think about is, my yield, that's not guaranteed.